Hello students, welcome to the lecture on financial management for hospitals, and after this lecture we will be able to learn the following objectives. Understand the current state of industry, discuss the investment activities, explain the financing activities, explain the long-term loans from Indian financial institutions, discuss the measurement of the efficiency of hospitals. Let's start with a brief introduction. The business of healthcare is becoming increasingly risky in terms of financial management. It is labor and capital intensive, and the utilization of some of the equipment and machinery rarely reaches the break-even level. The obsolescence rate is high. Cost of the equipment, land and building, personnel and other inputs spiral upwards constantly. The demand for service is unpredictable, while new hospitals are coming up at an incredible pace. They are growing in number in leaps and bounds, and the existing hospitals are adding bed strength every year.
My company owns and manages ambulatory surgery centers and hospitals all around the U.S. We had zero visibility into what these facilities were doing. All we could see is the financials, the end product. Since implementing Intact, we have already been able to show our executives the power of the information that they now have at their hands. They can make decisions a lot quicker, and they know what they're looking at. They can actually get to the information right away.
Renal Ventures is a dialysis company. We manage and operate dialysis facilities throughout the country. We have a joint venture strategy. So each of our operating clinics is its own individual joint venture, its own EIN, its own set of books. But we were on QuickBooks prior to moving over to Intact. So the way QuickBooks operates is they're individual databases, and there's not really a way to look across those individual databases. And now we have reports that have those key metrics that we use both operationally within finance and accounting. We use them for our operational team out in the field, and as importantly, we use that with our joint venture partners.
Without any training, I have set up some of our executives, and they have asked me directional questions like, is this the right place to go? But they had already done most of the figuring out on their own. It's allowed us to move away from so many manual processes that we're able to actually perform value-added services in analyzing the financials instead of just creating them or computing them.
As a healthcare company, specifically a dialysis company, there's key metrics that really drive our business, and the most important ones are really revenue per treatment, labor per treatment, and supplies per treatment. And when you can look at those things on an individual entity basis or within a region or across all of our regions and entities, it really provides insight as to which centers outperforming, which centers are right in the middle, and which ones are the underperformers.
Information is not useful unless you can analyze it and then make decisions based on that analysis. So now we're able to analyze the information and help our executives make decisions.
Intact has allowed finance to spend more time analyzing our information, and now we're spending our resources looking more forward instead of looking back at history.
Let us now discuss the current state of the industry. The healthcare market in India, with a population of 1,030 million growing at an average rate of 1.96% per annum, has the potential to become a huge market. Developed countries such as USA have a hospital bed for every 170 persons, whereas India has one bed for 1,120 persons. Thus, there is tremendous scope for establishing many hospitals in the years to come, if India wants to achieve standards of healthcare established by the developed countries. The promoters of the healthcare business are eager to establish more financial management for hospitals or increase the number of beds in the existing ones. Reasons for slow growth. The government, a major provider, even today is not providing sufficient funds to spend on healthcare or to meet growing health needs, which creates an entrepreneurial opportunity for the private sector. The return on assets is quite low, investment is too large, and gestation period long, which discourage new promoters. The break-even level of operations for some of the equipment is too high. The location choice of promoters is biased towards urban areas, leading to stiff competition, low occupancy, and consequently unprofitable operations. Some are finding it difficult to stay afloat. Industry characteristics. A puzzling characteristic of the healthcare industry today is unprofitable hospitals, even when there is a large demand and supply gap. Is it an inherent characteristic of the industry, or is this situation specific to how hospitals are promoted and operate in India? The answer seems to be both. The average Indian patient's income is low. Most cannot afford the high cost of the best health care in the private sector, and some, perhaps as a result of a cultural carryover, are not willing to spend though they can afford it. End is profit. Profit is the end result of a long chain of the management process. Planning, and as a function of management, has been understood as a continuous process comprising ends, means, resources, implementation, and control. Let us now discuss investment activities. Before making a commitment to invest in a hospital, it would be wise to have a feasibility study of the project carried out by a professional. This study must address both the technical and financial feasibility and include the following issues. Where will the hospital be located? What is the catchment area it wants to cover? What is the size of the market, the population that needs the service? It should be a detailed study of the size of the population, age, distribution, growth rate, morbidity, statistics, income levels, literacy levels, industrialization, employment rate, and other demographic and economic data with relevant forecasts. Who are the competitors in the area? Make an assessment of the size of their operation, expansion, possibilities, market position, their current market share, and their strengths and weaknesses vis via the promoters. This will give an idea about the market which the promoters may have to target and its size. What incentives can the local government offer? Governments in certain areas may offer various benefits for a hospital if it provides service to poor patients. This may be in the form of subsidies, grants, and so forth. The benefits must be measured and weighed against the costs before accepting or rejecting the offer if there is a choice. The project report. After all the points listed above have been covered, a proposal for the project can be formulated in the form of a document. This will give details of the amount and schedule of investment, the phasing details, revenues, and operating costs for each year for a given capacity until the total capacity is reached, or at least for the next 5 years. The profit or loss in each year of operation and cash flow estimates and break-even values. Let us now discuss another topic, financing activities. Following are the financing activities of a project. Stages of a project, choice of the project, market study, project preparation, and estimating the investment forms one wheel of the cart. The other wheel is procuring or gathering the capital or the money required for the investment. Financing requirements arise many times in the lifespan of a hospital. They may be classified into different periods: gestation stage, operational stage, expansion stage. The gestation period covers the period from the commencement of project construction to the commencement of operations. The operating stage includes the period during which the firm produces and sells the goods or services. The expansion stage is the period during which the hospital adds additional capacity in terms of beds, equipment, or the establishment of another unit. Financial planning. Financial planning of the hospital should lay down policies in respect of the amount of capital required at each stage, the sources in general and particular to be used to raise the required capital, the mix of different sources in the total capital, the target cost of capital for the hospital. Sources of finance. Once the quantum of finance is determined, the next step is to plan and procure funds from various sources at the minimum rate possible. The available sources will depend on the form of the hospital organization. Each form has some sources specific to it. A single proprietor-owned hospital or nursing home has limited scope in terms of its sources. Equity share capital owners. Capital is relatively easy to come by. It is permanent in nature and remains with the company as long as it survives. An owner's investment shows their commitment to the project and their belief in the future profitability of operations. The firm never guarantees any specific rate of return. Retention of earnings. For an existing organization, hospital, the profits made will be an internal source of finance, and it is a cheaper option compared to the public issue. This source will be of great use during the expansion period, but the size of the profits may be small and it may affect the shareholders' expectations. Preference share capital. This source of capital is almost extinct. It is advantageous neither to the investor nor to the company. It is an instrument with the characteristics of a debenture and also that of an equity share. Debt capital. Lender's capital is very difficult to get. It is a long-term source but rarely a permanent one. It is also called a loan capital or debt. The lenders are promised a fixed rate of return on their funds, irrespective of the profits or losses made by the hospital. Debentures and bonds. This source of finance is the most popular and commonly used by corporate India and is well known and understood by the investing community. These are debt instruments such as promissory notes issued by companies to the investors for the amount of funds borrowed. Let's now discuss long-term loans from financial institutions. The following institutions offer long-term loans to the corporate sector: Industrial Development Bank of India (IDBI), Industrial Credit and Investment Corporation of India (ICICI), Industrial Finance Corporation of India (IFCI). IFCI has been operating a scheme under which projects to set up new hospitals and multidisciplinary health centers or to modernize existing facilities that are financially viable propositions undertaken by corporate hospitals are eligible for financial assistance. Eligibility. Hospitals that use modern equipment or the latest technology to provide service to patients will be given due weightage, and projects promoted by medical professionals and non-resident Indians will be accorded priority. Norms of debt equity ratio and promoters' contribution. The minimum contribution from the promoters has to be 17.5 to 22.5% of the project capital cost. More investment by the promoters will encourage the financial institutions in general. The debt equity ratio must be within the limits of 2:1. Terms and conditions of the loan. Security must be provided for the loan. Repayment of the loan can be between 3 or 5 years. The rate of interest will be charged on par with other industrial organizations, but for modernization of existing hospitals, a low rate is possible. Nominee directors will be appointed on the board of directors of the company. Risk capital assistance. In case the promoters are not able to bring in the required minimum of promoters' contribution to the cost of the project, they can approach Risk Capital and Technology Corporation Limited (RCTC). Other institutions offering long-term loans: Industrial Reconstruction Bank of India (IBIM), General Insurance Corporation of India (GIC), Life Insurance Corporation of India (LIC), Small Industries Development Bank of India (SIDBI). Conditions to decide the amount of loan approval and sanction. Debt equity ratio of 2:1. Promoters' contribution in the total equity 25 to 50%. Whether the company is public limited or private limited. Location of the project, backward area or non-backward area. Operations activities. A hospital's operation contributes its service to the patients. Typical hospital services include outpatient consultations, diagnostics, therapeutics, surgeries, counseling, admission, transfer of patient within the hospital and discharge. Financial management during the operational period generally ensures smooth functioning in terms of its day-to-day activities. Increase a revenue. It can increase its revenue, which is the product of the quantity of services sold and rates charged. By changing one of these variables, the revenue can be increased. Most of the times, the rate set by the hospitals is not based on the cost plus method. They take what the nearest competitor is charging and add or deduct a given percentage to or from it to set the rate. This method is similar to target pricing. Reduce the expenses. The expenses include spending on items such as medicines, consumables, salaries and wages, supplies, rents and rates, depreciation, administration and marketing. Some of these expenses are the result of the activities of the current period, while some are due to past actions and decisions. Managing current assets. Managing current assets involves determining policies regarding the size of each current asset and maintaining their quality. Receivables, inventory, and cash are the current assets in any organization. Receivables. Receivables are the amount of credit sales that are yet to be realized from patients. The size of this asset is the product of the number of days and the amount of credit granted to the customer. Inventory. Inventory is another current asset that needs constant monitoring. Inventory experts say that an organization must keep inventory in order to avoid production stoppages and stock out losses. Cash. Cash is another important current asset. Cash includes bank balances too. It is the common denominator with which all transactions are settled. If hospitals can synchronize collections and payments of cash, there is no need for any cash balance. Managing current liabilities. Current liabilities are short-term obligations that mature within an accounting year. These include items such as creditors for supplies, outstanding expenses, and any short-term loans from banks and other sources. Now let's discuss a measurement of the efficiency of hospitals. Management of the previous three activities will lead to the achievement of the objective of increasing profit in a hospital. However, to monitor the efficiency of a hospital, it is necessary to decide the factor that will serve as a measure for efficiency and the yardstick, benchmark, standard. These are discussed as follows. Average length of stay, ALS. A hospital's revenue is proportionate to the average number of days a patient stays in it. The revenue may not be equal on every day of the stay of the patient. It will be high during the first few days and will wane gradually to a minimum equal to the basic room rent towards the last day. Age of the plant. In economies where inflation is of high order, hospitals that have old equipment are supposed to have lower operating costs as their depreciation will be low and higher profitability compared to a newly established hospital of a similar nature. Case mix index. A hospital is a conglomerate in more than one sense. It has innumerable services to offer. The average revenue per patient day or per day of a cardiac hospital is much higher when compared with, say, a maternity hospital. Free patient ratio. From the profitability angle, the lower the ratio of free patients to the total number of the patients, the higher will be the profitability. Competition. Competition has direct bearing on the hospital's profitability. If a hospital is operating at its full capacity, it means that it is operating in a profit zone and it can take some steps to beat the competition before it turns red. Debt utilization. The higher the debt in relation to equity, the more will be the risk for the hospital. Even though debt capital improves earnings for the owners, it must be used with caution. Intensive care index. Since higher utilization of intensive care units leads to higher revenues, it is necessary to calculate the ratio of intensive care patient days to the total inpatient days during a standard calendar period. Ownership. Type of ownership influences a hospital's operational efficiency. It has been observed that most proprietorship organizations are successful compared to other forms of organizations. It could be due to personal attention, centralized decision making, and a high level of control over operations. Labor yield. Almost 40% of the hospital expenses go towards labor cost. A hospital employs personnel with a variety of skills. Within each category of job, various skill levels are required and salaries are proportionate to skills. In an outpatient mix, it is a well-established fact that most of the hospital revenue is generated from inpatient service. Many of the inpatients may have been the hospital's outpatients. Occupancy. Occupancy is an indicator of a hospital's capacity utilization of its beds. This ratio is calculated using the number of patient bed days served in relation to the number of patient bed days available in a calendar period. Day sales outstanding. This is a measure to control and check the quality of its amounts receivables. A higher ratio is a cause for concern as it implies overdue accounts. Overdue accounts lead to bad debt losses, collection expenses and tied up funds. Inventory turnover. Since the second major element of hospital cost is material, it has to be closely monitored and controlled. The hospital must ensure the availability of materials of various kinds, while at the same time the stocks are kept to a minimum. Current ratio. In the ratio of current assets to current liabilities, traditional belief is that 2:1 is good. It only implies that current liabilities can be met even though half of the current assets are not turned into cash before current liabilities mature. But a 2:1 ratio alone never ensures fulfillment of this objective. This ratio, along with the days sales outstanding, inventory turnover ratio and amount of cash in total current assets, determine the liquidity position of the hospital. Profitability ratio. Profitability of a hospital may be measured in many ways. The two preferred ratios are pre-tax profit to sales and pre-tax profit to investment. Pre-tax profit to sales. This expresses how well an organization has managed its costs and generated revenues. Revenue is exogenous and market determined, the costs endogenous and can be controlled by the management. Pre-tax profit to investment. This measures how well an organization has utilized its facilities and investment during a given period. In a for-profit hospital, the profit should justify the investment made. This ratio can be studied in association with occupancy rates and the case mix index. They all tend to be higher in a profitable organization. Now in the end, let us summarize what we have learned in this lecture. The business of healthcare is becoming increasingly risky in terms of financial management. It is labor and capital intensive. The business of healthcare is becoming increasingly risky in terms of financial management. It is labor and capital intensive. Occupancy is an indicator of a hospital's capacity utilization of its beds. This ratio is calculated using the number of patient bed days served in relation to the number of patient bed days available in a calendar period. Type of ownership influences a hospital's operational efficiency. It has been observed that most proprietorship organizations are successful compared to other forms of organizations. The ratio of sales to inventory is a good measure to ensure efficiency in this area. A higher ratio will mean efficient material management in the hospital.